Hello everyone and welcome to This Week in the Markets. This week we'll spend a bit of time discussing the Fed's implementation of its QE3 program and what its implication is for the markets. But as usual, we'll first go briefly through our disclaimer. So information contained in this video is intended to be general advice only and should not be relied upon as financial product advice. Furthermore, the advice has been prepared without taking into account your objectives, financial situation, or particular needs. So you should, before acting on the advice, if you choose to act, consider the appropriateness of the advice having regards to your objectives, financial situation, and needs. So Bernanke announced on Thursday after the two-day monetary policy meeting that the Fed will engage in $40 billion worth of monthly purchases with a focus on mortgage-backed securities. This is the third round of quantitative easing by the Fed, but there are two distinguishing features of this quantitative easing which separates it from the previous two, namely the open-endedness and the focus on mortgage-backed securities. During the previous two quantitative easing programs, the Fed usually announces the purchase amounts and the intended timeframes for the purchases. However, that created an unexpected consequence because both the ending of QE1 and QE2 unfortunately coincided with the European debt crisis. The ending of support from the Fed eroded confidence and caused the market to fall even further. So the open-endedness of QE3 gave the Fed the flexibility to prolong the program as long as it is necessary and allowed them to stop the purchases only when the economy has picked up momentum. Secondly, the Fed's focus on mortgage-backed securities is to try to narrow the spread between mortgage rates and treasury bonds. This is aimed directly at jumpstarting the housing markets, which always plays an important role in the economic recovery. But it also creates jobs directly as banks will need to hire more staff to cope with rising demand for mortgages. The Fed's stimulus program was pretty much expected by the market, but what was surprising was the Fed's aggressive approach and its disregards for inflation. For the Fed to not give a fixed amount and end date to QE3 means that they basically have no fear for inflation, and they're basically saying that they will continue to flood the economy with liquidity until confidence returns and consumers start to spend again. Bernanke further added that the Fed will continue to pursue easing of monetary policies even after the economy strengthens for a considerable amount of time. So that again emphasizes their apathy towards inflation, or perhaps to the extent that they actually want to have inflation to promote spending. If we consider the 10-year break-even, which is the spread between the yields of inflation-linked bonds and the non-inflation-linked bonds, or we can look at it differently and it can also basically saying this is the market's expectations for inflation. So this has jumped up to the highest level since March of 2011, which is shortly before the conclusion of the QE2 program. If the past is any guidance at all for the future, which in this case we think it is, then inflation expectation will probably continue to rise during the life of the QE3 program just like it has in the previous two. So what does this mean for our trading? Well, firstly, inflation protection will probably be of high demand. That is one reason why gold and silver have soared so strongly in the past month. However, they are currently at levels that we fear might suffer some short-term pullback, given a lack of bullish catalysts in the short term. Base metals could also see a boost as a type of inflation hedge, but its industrial demand will be very dependent on the economy in China, where governments do not seem likely to be engaging in any large-scale stimulus programs to boost the economy. One area that we think could benefit tremendously from a sharp rise in inflation expectation is long-dated US Treasury yields, or basically shorting US Treasury bonds. That could sound a little controversial at first because the Fed's implementation of QE3 is to bring rates down. However, QE3 is more geared towards mortgage rates, which are typically more linked to the 10-year and bond yields, whereas the 20 and 30-year bond yields are more influenced by inflation expectations. So one only needs to consider the effect of QE1 and 2 on long-dated treasury yields to see that this is not so much an absurd idea. As we can see from this chart of the 30-year treasury yields, shortly after QE1 was announced, bond yields had a huge surge and spiked after the Fed stopped the QE1 program. So the QE2 did not seem to have as big an impact as the first one, but that was only because the Fed basically already told the market that there will be QE2 coming during the 2010 Jackson Hole meeting. So bond yields have already started surging then and started falling as the program draws nearer to an end. On top of that, the ECB's bond purchase program will also decrease the demand for US Treasuries as a safe haven asset. Part of the reason why Treasury yields are at record low is because investors are fearful of defaults in European sovereign bonds, like the case in Greece. The ECB's bond purchase program will act as a backstop against default and will likely attract back demand from bond traders. And if Q3 does succeed in reviving the US economy, there would also be a switching effect out of US Treasuries to equities and other higher yielding assets. So definitely we'll be keeping on our watch list the ETF TLT, which tracks the 20 plus years to maturity US Treasuries, and basically we're bearish on this ETF. And consequently it also means that we're bullish on the inverse ETFs TBT and TMV. So that's all from us today. We'll have another update for you next week. Until then, on behalf of the Trading Pursuits team, wish you all profitable trading.